Hey everyone, George here. And if you're looking for an easy way to outperform the stock market legend, Warren Buffett, you came to the right place. If you don't know already, Warren Buffett is one of the greatest investors of our generation. He's worth something like, I think, $80 billion dollars and some change. And today I'm going to tell you how to outperform Mr. Buffett in the market. Now I know, George,
Warren Buffett has so much more money than me. I'm only investing with peanuts. How can I outperform it?
yeah, you probably won't get richer than Warren Buffett overnight, but with what I'm going to show you, it will definitely help you outperform his recent trading strategies. If you know anything about Warren Buffett, you know that his trading strategy is buying value. He loves preaching in buying something you would buy yourself, which isn't that bad of an idea. That's why he loves these value companies such as Heinz. His bread and butter are value stocks, and value stocks are stocks that have inherent value based on their PE ratio or profit to earnings ratio. So that means their valuation is very close or somewhat close to their earnings. Companies like JP Morgan, Sunoco, and AT&T, which have lower PE ratios, so like I said, their valuation isn't some astronomical number, it's pretty close for a multiple of their earnings. Now, this isn't a bad thing. It's worked out very well for Berkshire Hathaway over the years. But recently, I think the market has taken a turn in what they expect and what they are more interested in. And I am by no means saying Berkshire Hathaway is a bad investment or they don't know what they're doing. They know way more than I do. But all I am saying is their way of investing and thinking where only value stocks are worth it is pretty dated and it's about to change. Currently in our market, we have these stocks called growth stocks. And the growth market is essentially a company that hasn't met its real value yet. They're growing, they have potential. So companies like Tesla, Nvidia, Apple, Square, Twitter, all of these companies have more potential and they're worth more than they are now because in the future they could have new innovations. Remember, innovation, it's a key word for growth companies because they are not looking for the short term. They are looking for the long term. They're not seeking to appease their shareholders for Q1, Q2, and Q3. No, they're seeking to appease their shareholders for the future. They're trying to create a massive product that will change the world. Think Ford versus Tesla. Ford, consistent, doesn't stagger much, consistently puts out roughly the same product, maybe a little update, a polish, slight adaptation to what the market wants, but they don't really change much. Versus Tesla, constantly putting out new EV models. They're pushing the boundaries of autonomy driving, trying to go full autonomy. Tesla has power cells, they have storage, they have solar, and they're going more and more. And that is a caveat to their founder, Elon Musk, who's a big innovator. Now, I'm not saying growth stocks do not have their inherent risk. There's always a risk in investing in something. Now, the growth stock risk is if their product that they have this picture for 10 years down the road doesn't come out to be promising like they said it would, the stock could just go flat. They didn't fulfill their promise. So a lot of people are upset, they sell the stock and it's worthless or it loses a lot of its value. But on the flip side, it could have exponential growth. Look at Tesla from 10 years ago to now. Look at Square from 5 years ago to now. These companies have had exponential growth because there is more adaptation to the market. People are adopting these companies more and more into their daily lives. Warren Buffett does not see the gain in investing into these companies. The risk is not worth it, which is why he bought Heinz Ketchup Company. I don't know about you. I'm not investing in a ketchup company. I love ketchup, but it's not where I really want to put my money in, right? I don't see big growth in the ketchup industry. I see them being consistent, right? Staying consistent, producing ketchup, but I don't see them coming out with, virtual ketchup where I can taste it when I'm sleeping. Now, I'm not saying he can't change or his investment strategies can't change. He did invest in Apple recently. But what I am saying, it feels like he fails to see the potential of innovation and the benefit it can have, not only to our wallets, but to society itself. He prefers the good old fashioned invest in something, save, see small returns and profit. But then again, he does have billions of dollars, and most of us do not have billions of dollars to invest in the market. Now, if you look at the S&P 500, it has outperformed Berkshire Hathaway the past 5 years. The S&P consists of the top 500 companies in the Nasdaq, and the Nasdaq consists of mostly tech companies, which primarily are growth companies. So more of the story is if you invested in the S&P 500 in the past 5 years, you would have outperformed Warren Buffett. You would have made more money than Warren Buffett by just investing in the S&P 500 and just sitting back and relaxing. I personally believe Warren Buffett and Charlie Munger are on their way out, and I don't blame them. They're in their 90s. They've been investing forever. They're legends. The more retail investors get into the market, the more unpredictable it gets. And the more unpredictable it gets, the less happy institutional investors are, because it's not as easy for them to just throw billions of dollars wherever they want and make money. In my opinion, times are changing and people are more interested to see potential growth in 5 to 10 years than what the next earning report is going to look like. That is why some of these valuations are so high and institutional investors are calling it crazy, because they don't agree with the premise. They don't see the future. They don't think the valuation should portray the future. They think the valuation should portray the current earnings reports. And that's why you see a lot of these companies skyrocketing, because people are starting to see the potential, the growth, and more they're investing in the potential growth than the potential earnings of the next report. So to summarize it, tech is doing good, growth is doing good, long-term companies are doing good that are trying to innovate, invest, not just trying to appease their shareholders, not just trying to stay stagnant and be a ketchup company. They're trying to innovate the ketchup industry, for instance, right? They're trying to make flying ketchup planes. So, crazy example, I know, but, something new. They're trying something new. And that's the whole premise of this new investing strategy. Look for something that can change the world, something that can improve your life in multiple ways. But guys, what do I know? I'm just some guy on YouTube, so do your own research and be careful and never invest in something you can't afford to lose. Thanks for watching, and let me know anything else you guys would like to hear about. I will see you guys next time.